You know Robert Martinez, the apartment rock star?
Yeah, I do.
So I went out and interviewed him back in October on
Where's
my
he,
podcast.
Texas? Is he in
He's out in
Texas?
Houston, Texas.
Yeah.
And this guy did 14 successful syndications, large multifamily syndications, all private.
What year?
He started in the game probably like in 2012.
Okay, so this
And
is
so he's done
okay.
14 successful syndications, and this was number 15. And yeah, so it was all over the Real Deal and everything. It was all over the news. But he foreclosed on a $54 million multifamily loan. It was a Freddie Mac floater, and he bought a Class A building in Houston with no value add opportunity, and was just banking on continued rent growth and for inflation to continue doing its thing. And he ended up basically losing $17 million of investor capital on that deal. The deal went back to the lender, and I went out there and interviewed him. But
Wait.
check this shit out.
Wait.
Mikey. Yeah.
Wait.
Yes.
Wait. Bought a stabilized building with Freddie debt, institutional debt,
Yeah.
banking off rent growth. So to qualify for that loan, the property was cash flowing.
Yes.
It stopped cash flowing. He stopped being able to pay his debt, and the property was taken.
Dude, it was a like perfect storm, dude. So what he said was this. So they bought the deal, and in due diligence, they did not discover this in DD, but he said almost 30% of the existing tenants were Airbnb arbitrage folks, people that were basically renting the unit from them, and then they were arbitraging on Airbnb. And so when the rate environment started going up, people stopped doing the Airbnb stuff, especially a lot of these markets got hit, like Houston. And so when the Airbnb stopped cash flowing, guess what they did? They just turned in the keys. And so all of a sudden, he took over his property. Within the first year, almost 30% of the tenants threw the keys back. So he took a big dip in occupancy there. And also, simultaneously, as he took over, he went from in-house property management, which he had for the last 10 years, to third party. So he literally let go of his property management business and went to third party. And the third party, he said, ran into the ground. And then he said the lenders were, trying to work with them. And he had to go back from third party and take all these assets back in-house, rebuild his entire property management team. And meanwhile, the lenders are working with them, and they're like, hey, we're going to work this out. And push come to shove, in the 11th hour of them giving him some sort of loan modification, because obviously the rate environment, it did its thing,
right.
And he bought it on a Freddie floater. A lot of people were buying on Freddie floaters back then, myself included. We got caught with 2 multifamily deals out in North Carolina, to where we bought them on Freddie floaters. They had the 1% prepayment penalty. It was cheap debt, right? Rates in the 2s, interest only. And then the rate environment more than doubles, right? Lenders got a lender reserve now. Our debt service quadrupled, and same with his. And so now he's in his pinch. His occupancy drops down to 70%. He's going back from third party to in-house. And so he's building out all his team again, bringing everything in-house. And in the 11th hour, when the lender says, hey, we're going to modify your loan, we're going to work with you, they tell him, they go, hey, we are only going to do this if you use third party. Not if you go in-house. And he's like, dude, I'm not going to do that, because he has all the other assets. And so he said it was the toughest decision ever he had to make, but he foreclosed on a $54 million note, $17 million of investor capital, bye-bye.
Oh my gosh.
Yeah. Right?
Worst case scenario to happen. I didn't know that.
Yeah, crazy. So it was all over the Real Deal, all over the news. And he was gracious enough to have me over to his spot, and he opened up about it for an hour. We just talked all about the mistakes that were made with that deal.
Oh, that is awful.
But to go full circle, and you never want to see this with anyone.
Yeah.
To go full circle, 2 things that you got to adjust, I think, in the last 30 months, and we've always done this, is one, it's 2 things. One, you got to buy a deal at a discount, right? You can't pay market value. And then 2, you got to buy a deal that has clear paths to add value. And if you can do that, it gives you a huge cushion and a margin for error should the market continue to soften.
Right.
And my sentiment this last 30 months, and I told investors this, is the market is going to continue to soften before it improves, right? But if we're forcing so much appreciation and value add, we have all this cushion and additional equity to where if it continues to soften before it improves, and it will continue to soften before it improves, we're going to be good, right? It gives us options.
So correct. When you say continue to soften, do you mean cap rate softening, or do you mean demand softening, or both?
Both.
Yeah.
Right? So, the rates more than double, demand decreases. demand for guests and this product decreases. So our NOI is going to decrease, but also, because of the rate environment, cap rates kind of lag behind the rates.
Right.
So we're in an increasing cap rate environment. So another way you can hedge your underwriting and be more conservative is to factor an increased exit cap rate, a much more increased exit cap rate than a lot of people were assuming
Right.
Back in 2021. I mean, a lot of these operators, I mean, I saw the people that were being awarded these large multifamily deals back in 2021, and like the pricing guidance didn't even fucking make sense.
Yeah.
And then the brokers would have 45 property tours and 35 offers, and then by the time you got best and final, these groups were overpaying by crazy amounts of money to be awarded these deals. Like we would circle back and be like, oh, wonder what that asset traded for, and be like some crazy number. Like, what are these people looking at? And those are the people that are in trouble right now.
Yeah.
They're in trouble right now.
That's right.
I know a lot of multifamily operators. I'm not going to say names, but I know a lot of multifamily operators personally that bought on a lot of aggressive assumptions, and they bought a lot of deals like I just alluded to, with not a lot of clear path to add value. And I know investors in those folks' operations, and they haven't been doing distributions for 2 years now.
Oh yeah. Oh, same thing happened to us. We were trying to buy a property in 2021, and it was, I think our first offer was somewhere around 50. I think it was 49 was our first offer. And when we were doing our underwriting, our cap was, I think, 54. Couldn't go past 54. Numbers just didn't make sense. And so we got taken out, right? Just like with multiple bids in higher than us. And then we reached out to the broker to see what it traded for. Like 65.
That's insane.
It's insane. And we were like, how? How do they do that, right? So my question to you is, on boutique hotels, what cap rate are you guys pretty much buying at right now? And then what exit cap are you typically building your assumptions off of? And then what's the stress cap that you're running after that?
Yeah. So going in, we don't care about the cap rate because all the hotels we're buying are like negative cash flowing.
Okay, so it's all pro forma rent and forward-looking cap rate.
So we're buying on pro forma. Now, generally speaking, for hospitality, general rule of thumb, hotel cap rate around the country, ballpark, is about 8%. Now, the high growth markets are going to be lower. The nice assets are going to be lower depending on class. So you got economy is always going to be your highest cap rate, right? The Motel 6s, the budget friendly motels. Now your nice assets are going to be a much lower cap rate. So
what's going to be the cap
San Diego?
Rate? What's going to be the cap rate for the place I stayed in?
Yeah, so cap rate when we bought that deal, going in, the market cap rate for that type of hotel was about 6.9%. San Diego's a higher growth market. We're assuming an exit cap rate of 8.5, just to be conservative, right? And so we'll sell that thing. Who knows what the cap rate environment will be when we sell it, but we were assuming 8.5 on the exit.
Okay, so do you think it realistically trades at 8.5, or do you think it trades for lower than that? You're just looking at, if it does trade at 8.5, this is what we're going to make.
Yeah. I'm thinking like worst case scenario, 8.5, and if the numbers work, that's great. But I think realistically, between now and the next 10 years, there's going to be an opportune time to exit where we're in a lower interest rate environment. I think ultimately a lower cap rate environment. So I wouldn't be surprised if that thing ends up trading in something closer to like a 6.5, 7 cap.
Okay. When you guys are bringing that, like let's use that deal for example, to investors, are you guys running the projected returns off of a 7 cap exit, or running it off an 8.5 cap exit, or both? Here's what we're going to target to do, and if we sell it at 7, it's this return. And if things soften, this is going to be our conservative return. Yeah.
So we go off of the conservative number and we just say, hey, these are our projections. It's based off of these conservative numbers. We don't, and I've seen other operators do this, and I think it's really cool, and it's something maybe we'll implement in the future, but showing, hey, this is like conservative, this is like aggressive, best case scenario, and then it'll likely be somewhere in between. I like that, and I think it's something that I would like to implement in the future. But to this date, I've always just said, hey, these are the conservative numbers. This is what I want them to base our decision off of. And in the event it's better than that, so be it. But I like showing the two possible scenarios. I think that's a smart move.
That's good. All right, I'm so curious about this because you just recently bought a yacht.
Yes.
Right?
Yes.
So congratulations.
Yeah, first boat ever.
What does something like that look like? Is a yacht like comparable to like a jet where it makes no financial sense, but you do play the depreciation game, and there's an experience and elevation aspect to it that is pretty rad. Mm-hmm. Is it comparable at all?
Oh my gosh. I've never owned a fucking jet, so I don't know about that. But
me
fuck,
neither.
man, I love being on the water, man. I don't know what it is. And you never really know until you buy the boat how much you're going to use it. People are like, oh, best 2 days of boat owner is the day of buyer and the day of seller. But oh my gosh, let me tell you, dude, since I took delivery of her 3 months ago, I've been on the water literally every single day, every single night. We were on the boat yesterday.
I've seen it. I see
going
your
out to
social.
Catalina, going out
Yeah.
to Catalina all the time. It's like, honestly, like, it's one of my favorite weekend things to do. Like I'll roll out of the office, either like late Thursday or like early morning Friday. We'll just head out to Catalina for the weekend, hang out there, anchor in Avalon, all sorts of cool things to do out there. There's a bunch of cool different coves and like areas just to go anchor and just enjoy yourself. And it really feels like a touch of like Nepali coast and a touch of Greece kind of blended into one, but it's only a 2 hour and 20-minute ride out from San Diego. And I'll wake up Monday morning in Catalina, pull the mooring. I'm in the office by 10 a.m. running a meeting. It's the best thing ever, dude. But
Next 2 years, are we going to see a crash?
basically losing $17 million of investor capital. Shit out.
Wait.
Mikey. Yeah. A high-rise condo is probably the worst investment that you could possibly make.
And they're like, I don't really care about cash flow.
We're targeting boutique hotels kind of in that 10 million and under price range.
A lot of people sell your house to rent. Most people will think you're nuts.
Every American has the ability to go out there, whether they believe it or not, and buy a single family home with very little money down.